So what a gift of equity is when somebody's buying a house from a parent or relative of some sort, that relative can actually gift some equity to them. It's like forgiving some of the purchase price.
Don't ever try to go put your son name on a deed by itself and just call it a day. Oh yeah, no, I put his name on the deed, I'm in good faith. That's another complete set of problems.
Wow. Welcome, everybody, to another edition of the Real Estate Solutions Lab podcast. I'm Tony Cardinali, your host, and I'm here with a couple of guests today to tackle some really complicated, in my opinion, issues and subjects around real estate law, real estate taxes, estate law, and how it all comes together with certain specific challenges in real estate that we run into quite often. I get calls for these kinds of issues or solutions quite often, and I always go to some experts, and I've brought with me today Jimmy Mouchayleh from JM Accounting and Advisors,
Yes.
Longtime CPA and accountant dealing with complex tax issues, and I'm going to have him tell me a little bit more about his background. And Philip Eliopoulos, always our estate planning and real estate law practice authority, and to share with us and these two together create a powerful team that can expose a lot of unknowns in real estate tax and real estate law. So I brought them together today to tackle a question I get a lot of, and we're going to riff on a couple other subjects, but we are going to cover gift taxing and gift of equity taxing and how it pertains to real estate, because there's a really cool solution that can come out of this for people that are selling family homes to their children or their relatives. So first, let's introduce our guest. Jimmy, tell us a little bit about your background.
Oh, first of all, thank you, Tony, for having me on your podcast.
Absolutely.
Jimmy Mouchayleh, JM Accounting and Advisors. I've been almost 30 years in public accounting. I service a variety of industry, mainly businesses and like related individuals with like our medium to small to wealthy people. And we've been in real estate for a long time, helping people to establish their empires and other things, and retail stores, hardware chains, and other things, through medical practices and so forth and so on.
So lots of stuff.
Yeah. It doesn't say is that he really takes a holistic approach with his clients. He doesn't just look at the tax return. He tries to see what else is going on in their financial world. So that's one thing you do that's
very
really
good point.
Impressive.
I've experienced that.
Thank you, Phil.
Yeah, and Philip Eliopoulos from Eliopoulos and Eliopoulos.
Yep, so I'm a real estate attorney in Chelmsford. We've been in practice now since 2000 is when I opened the firm. Wow. So we've been around for 24 years. We do a lot of real estate, estate planning, and business law. And those often dovetail into each other, which I know we're going to talk about in some of these topics. One can affect the other, right. So we try to focus on those main areas of the law. Yeah. We're located in Chelmsford. I've been practicing for 30 years. And I practice with my sister, who's my law partner, and there's two other attorneys in our firm as well.
Very good. And a great group of resources, I'd say, as well. Smooth closings, advice when you need it. Those are the things that we really count on with both you guys. Wanted to introduce a subject today that I get phone calls a lot. It'll be, hey, Tony, I want to sell my house to my kids. One of the biggest issues that come up from that is we want to give them a bunch of money to buy the house, or in our case, equity. We want to gift them some equity. Sometimes they don't even know that they can gift equity, and I have to bring up that as a solution. And so what a gift of equity is when somebody's buying a house from a parent or relative of some sort, that relative can actually gift some equity to them. It's like forgiving some of the purchase price. Mm-hmm. So when you forgive part of the purchase price to them, the person buying the home doesn't have to pass that money on to them, and they can finance a lot less of the house. That means instantly you could have equity in the home, avoiding mortgage insurance sometimes. And I've always been very willy-nilly about it. Yeah, just give them 20%, right. Until Philip brought up once, you we could talk about this a little bit more. It's not that easy. Or there's issues to bring up, and I wanted to, I don't know which issue we should talk about first. Is it, because they ask about gift taxing. I know that's a thing.
Yep.
And I always looked at that, what's the, gift tax amount that's required, the limit that the person can gift each year. But Jimmy brought up something to me I wanted to share with me today about gift taxing, how gift of equity comes into role. Talk about gift taxing first.
Yeah, let me say one thing clear to everybody. When it comes to taxes and filing and all of this gain and losses and all of this, most likely the IRS has the burden to prove the income, and the taxpayer has the burden to prove the deductions and the expenses.
Okay.
If you look at it from this perspective, if I buy a house that's worth $1 million for $500,000, now I have a gain of $500,000.
Oh,
Uncle Sam wants his share of that. Where is it going to come?
right.
Now or later on? So this is where the whole thing comes into play,
Okay.
where I give my kid a house that's worth $1 million for $500,000, but I gifted him $500,000, and there is a gift tax return to be filed.
Right.
Now you file a gift tax return to establish the basis for the kids to say, this is now I gave you a house for $1 million.
Yeah.
I gifted you half. You paid me for half.
Right.
Now if the kids sell the house, okay, his basis start at $1 million.
Okay.
Now, when you look at it from gift perspective, there is specific rules about that. You pay taxes or you don't have to pay taxes. There is exemptions. There is other things.
Yeah.
But the fact you established that basis, you gave them basis for the future, properly documented by the IRS. And most likely is acceptable if it's close to fair market value that you use for the house, is acceptable by the IRS, and nobody can challenge this transaction.
That's the key, is to document it, because when we do a real estate transaction, so let's use that example, $1 million house, we're going to do a gift equity, say, of 300, so that they can, not be in a PMI situation. So on the HUD settlement statement, it's going to show that the house price was $1 million. There was a $300,000 gift of equity. Seller, received a check for $700. We'll keep it simple. We have to report the sale of the property to the IRS as $1 million. That was what was on the deed. That was the technical sales price. So the IRS is thinking $1 million transaction occurred. And unless you file that gift tax return, there's nothing really to prove that the seller didn't get $1 million.
Right.
And there's nothing to give the buyer a true step up in basis to $1 million, so that when they go to sell the house someday, that will be factored in. So that's the key, is sort of working with an accountant and understanding how to document it the best way, so that everyone's getting, both buyer and seller, both parent and child, are getting the best tax treatment possible.
Exactly.
The other thing that a seller has to be aware of is they still might pay capital gains taxes in that transaction. So husband and wife can shield up to $500,000 in gain, but houses these days are going way above that.
Yeah.
So I think sometimes parents don't realize, I gave my kid a break, but now I'm going to get hit with these capital gains because I'm selling my house for more than $500,000, and maybe my basis was low. I've been there for 20, 30 years. So I see that where sellers realize after the closing or months later, they say, I didn't realize I was going to get hit with tax on this transaction.
Got it.
So there's a lot of things to really flush out before you finalize that transaction.
Got it.
I would like to clarify something Phil brought up in his points. Sometimes houses are in a family for a longer period of time, and they are passed from generation to another, like two generations. So if you don't have the basis to start with, proof of basis, because these laws to proof basis are been forever.
Yeah.
So the grandfather passes it to the kid, and the kid to the grandkid, and it becomes like, really you don't have any basis.
Lost.
Even the grandkid
It's
get
not
the house
documented.
at zero basis. If it's not proven properly, the chain of how the house was transferred from one ownership to another. Now, the other thing I see common people do, and it's a big mistake. They say, oh, let's put the value for, instead of like 800, let's put the value for 500. If the value is not close to the fair market value, you give an IRS a leg to stand on that it's not fair market value at the time of the transaction.
Right.
And what happens?
and then the IRS can challenge it and can tax you, can say, okay, you just didn't report properly. They can assess you on taxes on a different level.
The seller?
The seller and the buyer, they can assess,
Okay.
they can follow.
Affects both parties.
Wow.
So it's important
So
to
it's
document.
important
That
to
happens
document.
often. The parent will be selling the home. The first instinct is to sell the home at a deep discount to the child.
Right.
I'm going to sell the house to you for 700 grand, not $1 million because it's
Yeah.
worth $1 million. 700 grand, you can take it away. And then they get me on the phone, and I say, well, wait a minute, guys. Now you got to put another bunch of money down for down payment. Why not ask for a gift of equity instead? Sell it for fair market, take the gift of equity, start with an instant equity position.
Document it after
Document
the
it.
transaction, and
It's
then
the key.
everything's fine.
So good advice to not sell it at a discount, way below fair market value. Is there how far too far is below market value that causes issue, or?
5-10%.
5-10%, like, you know, 5-10% is like something they can, like, you know, maybe be able
away
to
with.
get
Yeah.
away with the IRS, because any valuation is based on comparative numbers.
Yeah.
And could be like, you know, one up, one down, conditions of the house
Yeah.
or the property or something. That is a variable. But more than that, it becomes like really difficult when you start talking about house. The pricing of the prices are in $1 million,
Yeah.
700, 800. 10% is $70,000.
Yeah.
$70,000 on a 30% tax bracket makes a lot of money for the IRS.
Yeah.
It does.
Definitely.
Where do we start then? So if I get that phone call, and people listening will be saying, you know, I'd like to sell my house to my child as I move out and into a smaller home and give them a starting point. Where do you start? Do you sit with an accountant first and say, thinking of doing this, or is it an estate planning situation or tag team? Where do you start?
I think it's both. I think it's the real estate attorney can set up how the transaction is going to work with the lender, right? You know, Tony's going to say, all right, ideally, we'd want to set the true price at 7 so that they only have to borrow 5 and there's no PMI. The house is worth $1 million. All right, how do we get to that 7?
Got it.
You know, and structure it maybe as a gift of equity.
Yeah.
But then they've got to work with someone like Jimmy to document that gift of equity by filing that gift tax return so that the parents are not getting hit with that, you know, added cost. The kids are getting the step-up basis and everything's properly documented after the transaction occurs. So I think it's probably takes all 3 parties to kind of work together, maybe before the closing's consummated.
You know, I would say the same thing. If you had an estate planning before ahead of time, so all these parties are involved already. But if you're coming to start the transaction without an estate planning, okay, then you're gonna have to make kind of like you say, quick mini estate planning. But you still have to bring all these parties into the game to be able to ensure like all your steps are correct and documented properly for the future. That's all.
Man, I'm glad we did this. This is that none of that really has ever come into my brain when I'm talking to clients, because they call me with this, and I've worked out the numbers so that the transaction works out for the buyer in the way they want it to, and the way they would benefit from it.
Right.
None of that what I have known is coming into play unless we had this conversation. And so thank you for that.
Yeah. One more thing I would like to add to the subject.
Please.
Don't ever try to go put your son's name on a deed by itself and just call it a day. Oh, yeah, no, I put his name on the deed. I'm in good. That's another complete set of problems.
Wow.
From legal perspective, and let Phil talk about the legal side. But from tax perspective, definitely it creates a lot of problems.
Does it really?
Yeah. Well, let's do that as a separate topic.
Yeah, that's a good separate topic. All right. So staying on the gift topic, number one, we've figured out that gift equity is a great way to provide a benefit to a loved one, a child, anybody in a relative position, to provide them instant equity, down payment assistance, whatever it might look like. Let's talk about the cash gifts that happen. A lot of people today are short funds for closing on a home. They don't have enough savings yet, and their parents just want to gift them money. And sometimes it's $50,000, $100,000. Sometimes it's $15,000. And that's where I brought up to you one day that, you know, everyone asked me about gift taxing, and I say, obviously I'm not going to answer that question, but you brought up some cool information that could help people sort of in a general way about how does gift taxing work for cash gifts for a family member?
In general, there is no like gift non-accounted for.
Right.
All the gifts, if you give it cash or you give it in property, it has to be accounted for because
Okay.
there is certain exemptions allowed to you,
Yeah.
and you have a one lifetime gift that you have to use smartly,
Yeah.
technically here.
Okay.
Now, people have this thing saying if the IRS, I give like $15,000, $17,000 a year for a person, that is like a gift tax-free. The gift is not tax-free. The gift is exempt under your exemption, your personal one life exemption, one-time life exemption. That's
As
why the
the
IRS
donor?
is saying yes. But
Okay.
if you come to do, if you report that you cannot do like, all of these every day for like 10 people and do not report gift tax returns. So this is where the misunderstanding. If you give somebody like, 1 year, like 15 grand, okay, the IRS is saying, okay, I don't want to bother with this reporting now for 15 grand.
I don't need to file a gift
Yes,
tax return.
I don't need to file a gift tax return for every person give a 15 grand for his son or his kid.
Yeah.
Do you know what I mean? But if you come to look at it, if you're going to do that, trying to shift your assets from you to your kid for any reason, okay, then you're going to have to look at the gifting and report it properly to be able to shift it properly because it could create an issue.
Yeah.
Cash or non-cash, it will
Right.
create an issue with the IRS. Well, IRS will see that somebody's trying to avoid taxation,
Got it.
taking it usually from high tax bracket to lower tax
Yeah.
bracket,
Right.
and that's create another problem.
Yeah.
There is kiddie tax,
Yep.
and there is skip generation tax, which is
Okay.
might hit you harder too if you give it to your grandkids, and there is a bunch of issues
Really?
if you don't document them properly.
So let's just keep it to the real estate transaction. Son's buying a property, needs some money for down payment.
Yes.
In 2024, the gift tax exclusion is 18 grand,
18
right?
grand, yes.
So dad gives 18 grand, mom gives 18 grand, it gives 36 grand for the son to put towards this purchase.
Right.
Yes.
We don't have to file a gift tax return.
We don't have to fight it. Actually, it can be 72,000 because the mother can give to the son or the daughter and the spouse.
If they're buying together,
Yeah,
right? We can
you can double it,
compound
and then
it.
you don't have to fight this tax
Now,
return.
so let's just keep it simple. We each give 18 grand to our kid. They have 36 grand to put towards the transaction. I don't file a gift tax return. Is that technically that one transaction? Is that eating into my $2 million
Yes,
exemption?
it does.
All right, so that's
How do you keep track of that?
You see,
How does the IRS keep track of it? It's a better question.
when you do these transactions, when you do these transactions, there is paper trail.
Right. Right. Money's
Okay.
going into the
Public.
because
I'm
you
gonna-
probably need to see that money
I
was
would.
deposited to
Yep.
do the loan.
Don't you ask like for a copy of a check sometimes?
we would
So
document all of
documentation
it.
So
Yeah.
you already documented the gift.
Yeah.
If the IRS see like, his son is getting every year 15, 18, 19 $1,000 coming here, where is this money is coming from? The
Yeah.
question is, the IRS is looking and seeing revenue.
Yeah.
Oh,
Yeah.
that's revenue in your bank account.
Yeah.
Now, proof it's differently. If you don't do the right thing,
Right.
then it's taxable for the IRS immediately.
And we would typically have it deposited into the son's or daughter's bank account.
To show
And
it.
there's the revenue that showed up, and the IRS is like, where'd that come from?
Yeah.
Right? So they have to keep track of it, but they're not, the tax isn't due that year, right?
Because if it's still under the exemption, the personal exemption,
There's no tax.
there is no
It's
tax due.
non-taxable.
So we take that position. But if I don't file a proper gift tax return,
Yeah.
the IRS can say, I don't care. It's not a gift. You didn't file properly.
Right.
Do you know what I mean?
Yeah. So very common, I wouldn't say very common, but a client calls me, they're getting a very large gift, 100 grand or 75 grand. What does a person getting a huge gift like 75 or 100,000 have to do? Who has to do something, and what do they have to do? Just to have a general idea.
It's the giver of
The giver has to file a gift tax return.
Gift tax return.
Gift tax return.
The donor.
Yes, the
Yeah.
donor I don't think a donor has different terminology in
Okay.
tax laws.
Okay.
The one who gifted the
parents,
return has to file a gift tax return
Yeah.
to start eating at his exemptions properly with the IRS that this
Okay.
is what I filed as a gift tax return. From that perspective, you gave the one who received the gift step up in basis for the value that you just gave them. At the same time,
Yeah.
do you know what I mean?
Yeah.
If I gifted cash and I filed I gifted my son cash
Yeah.
or my daughter, I give them cash. I give them that cash. I proven with the IRS that this is not revenue. It's from me as a gift. It's not revenue to be taxed on individual income tax
Yeah.
for the kids.
Okay.
And at the same time, if it's a property, I gave them a step up in basis, documented with the IRS at the time. No
Okay.
taxes due, nothing. It's just filing a return.
So the property purchase price is 700 grand. I got 100 grand from my parents, so I only came up with 6. My basis is still that 700 grand that I paid for the property.
Got it.
Because of the gift tax return.
Okay.
So now you can do 2 things. If you have equity, if you're gifting equity and you're giving cash, you can file one tax return, one gift tax return for both.
Yeah. I don't see that happen a lot because the gift of equity solves a lot of the cash problems that a child would have. And during a gift of equity transaction, we will have the donor also be paying for closing costs often, taxes, insurance with a seller credit.
Yeah.
This kind of comes out of the scenario the way we put it together. So a buyer, a child, can come in with $0 sometimes to buy a home because we've structured the scenario so that 10 grand donation back to the kids for closing costs, taxes, or insurance at the time of closing, plus their gift of equity, takes care of it.
Again, it's like there's not a donation; it's a gift.
Yeah.
And it's like a part of one transaction. They get cash for closing. They got equity in value. It's still a gift.
Has to be documented.
Right.
Really good information.
Yeah.
Thank you guys. This is incredible. Talk about, Philip, you had brought up another subject. I think we were was it trusts in real estate and estate planning, taxes, stuff like that, right? There's issues when it comes to selling a home to a child or buying a home from an estate or something like that.
Yeah, so I mean, ultimately, we always want to try to get that step up in basis. So a lot of times, Jimmy kind of alluded to it, parents will say, well, I'll just put my son's name on the deed, and then when I die, it goes to them. So it's the worst possible thing you can do because you've basically created a zero gift of zero value.
Okay.
So Dad puts the house in my name while he's alive.
Yeah.
Then I go to sell it. My basis is 0 because I didn't pay anything for it.
Okay.
So better that Dad leaves me the house in his will, or maybe Dad puts the house in a trust that's drafted in a way so that it's includable in Dad's estate. The house automatically goes to me when Dad passes. Now I get a step-up basis. And so we always want to preserve the step-up basis when we can because we don't want to pay capital gains. I go to sell it a year or 2 later,
right?
And all of a sudden it's worth $1 million. I'm paying tax on $1 million because it wasn't structured the right way.
Because you didn't have any cost to buy the home.
Or I could pay 0 tax. I mean, you could be talking about paying a $250,000 in unnecessary taxes because it wasn't structured the right way. So we design trusts that specifically include the property in this case, the parent's estate for estate tax purposes, but give the child that they really want the property to go to a step-up basis for capital gains purposes.
Phil made it so easy. I'm just going to be honest about it. But when it comes to do trusts, it becomes a different layer of complication with it from tax perspective. Because you have revocable, irrevocable, you're gifting to the trust or you're not gifting to the trusts. What's happening into all of these conditions, like how do you do it? Now, the best scenario, Phil described it, how to move it here. That in this case, it will be a disregarded entity, the trust in tax laws called.
Okay.
That disregarded entity do not get activated.
Okay.
Kind of sort of until the death occur of the person who's doing it. And from there on, you become to follow certain inheritance and trust tax laws and regulation about it. But that's the best way to do it, is to do this part. If you do it, you complicate it more, you're going to have maybe gift tax return if you're gifting, revoking, or not revoking. But the way Phil does it with a trust is a disregarded entity until the death occur.
Right.
Got it.
And that saves a lot of headache until we deal, you deal with it after the fact.
When should this occur? So people listening to this might be sensitized to this subject because they know this is coming down the road. Maybe they need to set up an estate. They're getting older and thinking of maybe selling their home and moving out and to a smaller home, and they want to create some estate for they want to leave something for their kids. When do they have to start doing this and thinking about it? When should they reach out to someone like you guys?
It's never too early to start thinking about an estate plan,
planning.
right? If you're a homeowner, I always tell my clients, okay, you own a home now.
Yeah.
It's in your name. This is a good time to think about having a basic estate plan. Where do you want this house to go if you passed away? So I don't think it's ever too early to think about an estate plan, or ever too early to have something reviewed that may have been drafted 5, 10, 20 years ago, right?
Yeah.
So I think really, I see, I just met with a client who had an estate plan done by another firm about 10, 12 years ago. They created a trust, the purpose of which was to provide some estate tax protection, like an AB trust, not to get too in the weeds. But then nothing was put in the trust. The trust is an empty shell. I met with them like, yeah, our assets are protected. They're in this trust, and we're not going to hit with taxes. And I'm looking at the bank statement and the stock statement, and it's still in their names. I said, you haven't transferred anything into this trust. You don't have any protection here.
Grief.
So it's never too early to have that stuff reviewed, or on a regular basis, I think.
The trust itself, just quickly about that here, the trust can be on assets, but you still pay taxes under your personal individual, just to make sure, like we clarify that point.
Yes.
Even if in the trust assets, I can still pay taxes under my name, under my joint or personal or individual tax return. From that perspective, that's why the trust, we say it's like kind of stable, but you protect the assets for other reasons. You put them in this trust and you transfer them and you do it properly.
Right.
So just to make sure that clarify this point, you can transfer things to assets, but you have to do it the right, you can transfer assets to trust, but you have to do it the right way, but then you can still report to a long period of time on your personal tax. The other thing I would say, the biggest mistake is people, they think, I don't need to do an estate planning. The estate planning doesn't work. Doesn't work if you are 60 and something happened to you and you didn't do the right thing about it.
Right.
What you need to do is, as soon as you start having assets and evaluation, start your estate planning, and don't wait like 5-10 years to review it.
Very smart.
Because nobody knows what's going to happen with them.
That's right.
Keep that on in like a kind of like a 2 years basis. Review it and make sure it's the right thing is done. And all of it, because that's the biggest problem you create when you ignore it and you don't review it on a regular basis.
All the more important reason to get together early.
Yes.
People in their minds are thinking, how can I know there's some taxes coming, how am I going to avoid this and not, pay everything out to the IRS? That's what goes through people's heads.
Right.
They don't know all these things, and that's why I think reporting, sitting down early in a person's life and setting up these estate plans and tax shelters, can you call them that?
Tax planning, right? It's estate planning and tax planning.
It's more than shelter. It's a tax planning. You plan today based on the tax rule regulation that you have already here and what you have seen before, and what is it in there, so you plan for the future. But down the road, who knows who's gonna, if somebody has a crystal ball, please give it to me. What the numbers would be.
I know.
Wow, this has been an extremely helpful conversation today. I think next time we can talk more about buying a home in an LLC, doing something like that, because there's a lot that has to do with taxes and estate and legal planning, real estate planning, 1031 exchanges, investors. There's a lot of people investing in property now, maybe not doing it correctly, and so we can give them some information about that next time. Does that sound good?
That'd be great.
Happy to. That would be great.
I appreciate it. So, Jimmy, tell me, how do people get a hold of you to get some advanced tax planning, in emergency tax planning, whatever it might be?
Any emergency, I'm just going to give my phone number now. We are rebuilding our website. My phone number is 978-710-8202. That's my direct phone number, or my email. You can email me directly. JimmyM@jmAALLC.com, please.
Great, and I'll put all that in the show notes so people have it. And Philip, again, tell us.
Yep, call the office, 978-250-3800. That's the easiest, but you can also email me, Philip, at Eliopouloslaw.com. It's ELIOPOULOS.com.
Thank you, guys. I appreciate
All right,
you
thanks for
very
having
much.
us, Tony.
Yeah,
Thank you.
I really
Thank you,
appreciate
Tony, for
coming
having
out.
us. It
Yeah.
was an exciting half an hour.
You already got 2 topics in, but we'll work on it next time. Thank you.